Welcome to The Deep Dive, the show where we take a mountain of information and really distill it into those critical insights you need. Today, we're putting GlobalFoundries, or GF, under the microscope. We've just absorbed, well, pretty much everything from their second quarter 2025 financial results call. And it tells a fascinating story about a truly pivotal player in the semiconductor industry.
That's right. It's always intriguing to sort of peel back the layers on these earnings calls. On the surface, GF delivered what looked like a solid beat for Q2, comfortably exceeding expectations on both revenue and earnings. However, the market's reaction. Well, we saw a pretty significant dip in the share price right after the call. That suggests there's a more nuanced story here. It wasn't just the Q2 numbers. The forward outlook, it left investors with some pressing questions.
Absolutely. So for this deep dive, our mission is to unpack those Q2 numbers, dissect what management is really saying about their strategy, their direction, and then zoom out to understand what all this means for GF's trajectory in, well, a highly dynamic global market. We'll walk you through the reported results, discuss the big strategic shifts they're making, look at their guidance for Q3 and beyond, and explore the broader industry context. Think of this as your shortcut, really, to understanding GF's current position and maybe where they're heading. Okay, let's jump straight into those headline numbers from Q2. GlobalFoundries reported GAAP EPS, that's earnings per share using standard accounting, of 41 cents, and their non-IFRS EPS, which often gives a clearer picture of operations, came in at $0.42. Both figures comfortably beat the consensus estimate, which was around 0.26 cents, so a solid performance on earnings.
And on the top line, revenue came in at $1.688 billion. That was slightly ahead of the $1.68 consensus, and importantly, it represents a 3.4% year-over-year increase. So positive growth, even in what's been a challenging market.
Looking at profitability, the company achieved a non-IFRS gross margin of 25.2% and an operating margin of 11.6%. Free cash flow remained robust, really strong actually, at $277 million, which is significant because it bolstered their already strong cash position, now standing at a healthy $3.9 billion. So if you just look at these numbers in isolation, it really does seem like a strong beat across the board. But like you said, the market reaction, quite different. That disconnect is fascinating. Okay, let's unpack this then, because those headline numbers clearly didn't tell the whole story, not given the market's immediate sort of negative reaction. We really need to look beneath the surface, look at the full quarter, and crucially, what their forward guidance actually said.
Right. And what's truly fascinating here is the diverging performance across their different end markets. So while smart mobile devices are still the largest segment for GF, roughly 40% of Q2 revenue, that segment actually saw a noticeable 10% year-over-year decline in revenue. Similarly, home and industrial IoT was down sequentially, although it did show modest growth year-over-year. This tells us they're definitely still feeling the pinch in those consumer-facing areas.
But the bright spots were incredibly clear. And strategically important, right? Automotive revenue, for instance, surged an impressive 36% year over year. It now makes up a significant 22% of total revenue. That's huge. And communications infrastructure and data center also showed strong growth, up 11% year over year. Management was quick to highlight these double-digit growth areas for the third consecutive quarter. That signals a clear shift in their focus.
Which naturally raises the question, how are they navigating this persistent softness in consumer markets like smartphones and IoT? Well, management openly discussed making what they called one-time adjustments to average selling prices per wafer, ASPs, for certain mobile customers. Now, this isn't just a simple price cut. It sounds like a calculated strategic move. For one customer, they're shifting from a fixed volume agreement to a 50% share of wallet long-term contract. The idea seems to be, look, they're willing to maybe take a bit of a hit short-term to secure a more stable, predictable, and potentially much higher value long-term relationship. It's a pivot away from just volume in volatile markets.
So it sounds like a classic long-term play, but maybe with some short-term pain involved. What are the risks here, making these ASP adjustments now? Does it look like it'll pay off? They did say these adjustments will probably lead to year-over-year ASP declines in the second half of 25, particularly for smart mobile. But they also stressed the pricing environment remains, quote, constructive in their high-growth areas, automotive and comms.
That's exactly the tension, isn't it? The immediate risk is how the market sees near-term revenue. But by locking in these long-term share of wallet deals, they're clearly betting on a more predictable, diversified future, especially in that mobile market, which is always up and down. And this plays right into their larger strategic story. We heard about several significant moves beyond just ASPs, like that exclusive manufacturing partnership with Continental's new AESS unit that's Advanced Electronic Systems and Sensors. That really anchors GF in the high-growth automotive safety stack. A massive win, given how much silicon's going into cars now.
Yeah, that Continental partnership sounds huge. And beyond that, they also announced a definitive agreement to acquire MIPS. For anyone not familiar, MIPS is a leader in AI and processor IP intellectual property, basically chip designs. That deal's expected to close later this year. Can you unpack what MIPS actually brings to GF? How do they plan to use that? Especially for new areas like edge AI.
Absolutely.
Yeah.
FTS is a big name in processor IP, especially with their RISC-V tech, which is a major innovation area. GlobalFoundries sees this as a way to integrate that valuable IP with their existing RF and power platforms, radio frequency, power management stuff. This basically enhances their custom silicon offerings for edge AI applications. AI processing happening right on the device, not in the cloud. They even put some numbers on it, maybe $50 to $100 million annual revenue initially,
Yes.
with the potential for hundreds of millions more over time. And importantly, at accretive gross margins. That looks like a strong potential growth engine.
And further highlighting that global diversification strategy, they announced a China for China Foundry joint venture, specifically targeting the growing automotive sector in China. How does this fit into their bigger goals, thinking about geopolitics and market share?
Well, this China for China strategy seems like a pretty smart move. Geopolitical insulation, capturing EV share, it lets their customers get GF's production quality within China. That's increasingly important for supply chains, right? It minimizes potential trade tension impacts and positions them for growth in one of the world's biggest EV markets. It's about building a robust, geographically diverse footprint.
Okay, now let's talk guidance. Because this seemed to be the main culprit for the market's negative reaction. For Q3, GlobalFoundries is guiding revenue between $1.650 billion and $1.700 billion, an adjusted EPS of 0.28 cents plus or minus 0.05.
And this is where the market got spooked. Both those numbers came in below what the street was expecting. Expectations were around $1.79 billion for revenue and 0.42 cents for EPS. So a miss. Management attributed it to a slower than expected market recovery in some spots and some volume adjustments from customers, though they did say they expect those volumes to be fulfilled in Q4, so maybe more of a timing issue. But, the market tends to react strongly to any downward revision, whatever the reason.
Right. Despite that cautious guidance, though, there are clear operational strengths. On a positive note, they're still on track for over $200 million in cost savings for 2025. That'll certainly help margins. And they reiterated their target of generating over $1 billion in adjusted free cash flow for the full year, all while keeping a disciplined CapEx plan, capital expenditures of about $700 million. They also expect factory utilization to improve from the low 80s in Q2 to the low to mid 80s in the second half. That should help gross margins. That consistent free cash flow is a big positive, especially in a capital-hungry industry like semis. So taking all this together, the strong Q2, the cautious Q3 guide, these big strategic shifts, what does it all mean for you as an investor or just someone trying to understand the semiconductor landscape? The market's good print, bad outlook reaction tells us investors are heavily weighing that near-term guidance over past performance and maybe overlooking some crucial long-term strategic moves.
Yeah, and if we connect this to the bigger picture, GF stock has really underperformed the broader SOXX ETF, the semiconductor benchmark. GF is down, 24% over the last year compared to the ETF's 5% gain. This underperformance was already there before the call, driven by, handset weakness, tariff concerns, maybe perceived limited AI exposure. So the strong Q2 beat, while good, just wasn't enough to overcome that cautious Q3 guidance and the existing worries.
Management did touch on inventory levels, too. They noted some customers, especially in consumer areas, took on a bit more inventory in Q2, maybe anticipating tariff impacts. That will naturally affect H2 demand as inventories normalize. However, they also hinted downstream inventories might even be too low in some areas, which could lead to demand spikes later if the market recovers faster. It's a bit of a mixed signal on inventory, really.
Yeah, it is. And it raises that important question. Can GF's strategic pivot really blunt handset cyclicality, like CEO Tim Breen suggests? Their increased focus on essential chips for critical things like cars and edge servers, backed by the Continental deal and MIPS acquisition. It's a very clear long-term strategy. And they pointed to over 200 design wins year to date, meaning their chips got picked for new products, with over 90% on a sole source basis. That indicates strong, exclusive customer traction for their specialized stuff. It's not just winning business, it's securing deep relationships.
The conversation also brought up the huge impact of government incentives, like the GHPS Act. GF highlighted that over half their capex, their capital spending, is expected to be supported by programs like that. This positions them as, their words, a domestically anchored specialty node champion. What that really means is they can expand capacity much more cheaply, basically, which is crucial in an industry needing massive investment. It's like getting a discount on growth.
And that's a huge competitive advantage, right? While execution risks are still there, fab utilization still projected in the low 70s for the year, near-term pricing power limited by that Q3 guide. The company's consistent free cash flow and that big $3.9 billion cash buffer provide a solid foundation. Plus, their track record of 4 straight earnings beats does build some credibility, despite this recent market reaction.
So as we look to the second half of 2025, the key things to watch for GF will be closing that MBP's deal, the volume ramps from Continental, any more CHP as grant news, and of course, any signs of a smartphone pickup. Investor community will be watching closely. Can these auto and edge compute wins translate into sustained growth, or are they still too tied to the handset market finally finding a bottom?
All right, so let's shift gears for our "this is not financial advice" segment. Let's play VC for a moment. Let's cook up an outrageous but plausible trade idea based on this GF deep dive.
Okay. Considering the market's, well, seemingly short-sighted reaction to the Q3 guide, despite all these big strategic pivots and government support, what's your pitch? What's the bold move you'd think about?
My pitch is what I'm calling a GlobalFoundries essential chips arbitrage.
No.
The idea is this. You go long GF. You bet heavily on that long-term story, diversifying into high-growth, higher-margin areas like auto and edge AI, areas backed by serious government subsidies and a capital-efficient expansion model. Simultaneously, you go short a pure-play, consumer-centric foundry, or maybe a general-purpose one that's still heavily exposed to the choppy handset recovery and less insulated by those geopolitical incentives.
That's definitely bold. And specific. You're essentially betting the market's current view of GF, still weighed down by consumer cycles, and near-term noise will eventually catch up, that it'll re-rate to acknowledge this emerging profile. Specialized, diversified, government-backed essential chips provider. You're isolating the good print, bad outlook noise versus the bigger strategic shifts.
Precisely. The outrageous part is the timing, right? Handset recovery is still, well, elusive. But the plausible comes from that unique mix. MIPS acquisition, the Continental deal, the China strategy, and especially the multi-billion-dollar CHPS Act money. All these things are working together to accelerate GF's shift away from consumer volatility toward a more stable, higher-value future. It's basically a bet on strategic foresight, winning out over cyclical noise. It's about seeing the long-term forest, maybe, when the market's focused on the short-term trees.
Okay, so to quickly recap then, GlobalFoundries delivered a strong Q2, beat expectations, but their Q3 guidance was more cautious, and that unfortunately led to a pretty significant market reevaluation.
Right. However, beneath that immediate reaction, the company is actively executing on what looks like a really compelling strategic roadmap. They're aggressively diversifying into high-growth essential chip markets, think automotive, edge AI, and they're smartly leveraging global manufacturing plus substantial government money to drive capital-efficient growth.
The road ahead for GF will really depend on how effectively they turn these strategic wins partnerships, acquisitions, into sustained top-line growth. And of course, whether those consumer markets finally find their footing. It's definitely a story worth watching closely as the whole semiconductor landscape keeps changing.
Absolutely. The whole arc here seems to bend away from consumer volatility towards this diversified essential chips growth story. So the ultimate question for you to think about is maybe this. How much of GF's future growth is already kind of baked in by these strategic investments and government partnerships, regardless of the near-term consumer cycle? Is the market truly appreciating the potential long-term stability and growth that comes with being a domestically anchored specialty node champion and what's becoming an increasingly fragmented global supply chain?
And just a reminder, everything we've discussed today is purely for informational purposes. It is definitely not financial advice. Thank you for joining us on this deep dive into GlobalFoundries. We encourage you, as always, to continue your own exploration of these fascinating topics.